Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group, here with Andrew Thrasher, Chartered Market Technician and one of our portfolio managers. Very thankful you're giving us a few minutes of your time. Again, here we're looking at March 31st, last Market Carver of the quarter, and hope to see you sometime in April as we get together and have our third lease. So, Andrew, that's just right around the corner here, believe it or not.
It is. I'm looking forward just to finally being warmer weather. I'm just so over this time of year every year, and it's so cliche to say, but man, I am over winter. I am tired of being cold. So hopefully, even if it brings some winter showers or something, we can just get back into the 70s. I'll take it.
Yeah, no kidding. And I was reminded of going through several of my analyst notes of the companies we follow, and Booking was one of those. And I was reminded of the term I hadn't seen before, which is bleisure. Have you heard the term bleisure?
Is that I'm not even going to try to figure out what it is. What's it a combination of?
Business and leisure travel. So one of the things that Booking, which does a lot of bookings, finds in their future going forward are the work from home crowd that is book places for a combination of business and leisure. So maybe that's a smudge word we'll hear more going forward, but it makes sense. And I bet this time of year, they certainly see a lot of interest as we're tired of seeing the gray. I'm right there with you. So on to this week, we're going to talk about the bond market, which continues to be breaking records in terms of the downside. We'll take an update on the equity breadth and risk appetite, and then look at some of the impacts, not just in the United States, but globally of the food and energy impact. So we'll just start with that bond market. One thing that we have hit here over time is that there's an inflationary and a deflationary playbook. And one of those things that's in the inflationary playbook is that it's terrible for bonds. And that is exactly one of the reasons we're seeing bonds finally react and succumb to the gigantic inflation numbers we've seen. On the screen here, all these gray lines are individual years of the Bloomberg U.S. aggregate, which has a history going back into 1989. And you can see we're tracking the worst so far in history. Whether or not we'll continue remains to be seen. But it has truly been a very tough year. And I will say that it's been very helpful to be playing that inflationary playbook, because that's one of the moves is being quite defensive. Doesn't mean we've been able to avoid all of the losses, but we have been very defensive on this side. One thing of interest that I'll note, we give you, when you come in for your family update, 3 different indices to compare and look at returns to get some flavor of what's out there. We don't like just looking at the S&P 500 or just the Bloomberg U.S. aggregate bond, but instead blend into the indices. And that's one of the things we've seen, is that the conservative indices now are down by more than the aggressive ones. And that's due to this historic bond market. And Andrew, I'll let you bridge the gap here and hit the other chart that you brought, which is it's not just the United States. And if we look back deeper into history, it actually is even more record breaking. So.
Yeah, so this chart goes all the way back to, you can see there on the far left side, 1915, and then a few major events circled at the bottom: Treaty of Versailles, Gold Standard, the Marshall Plan. And this looks at global bonds. So it's like it says it titled there, the world government bond, GDP weighted. And you can see this is not just, like Adam said, it's not just the U.S. bond market that's seeing some tough times right now. It's actually across the globe as internet, specifically in Europe, Asia, and then definitely Russian bonds are seeing some weakness here. A lot of the central banks right now are starting to raise rates. When you have coordinated efforts like that, they're all raising rates, that's going to put a lot of pressure on bond prices, and we're seeing that across the globe. So for fixed income managers, they're going to be a little bit more tactile and where they're getting their allocations, and that's something we're definitely discussing every week here at FEG.
Yes, sir. And it's as a long-term bond guy, I know it's got a very nerd streak, but it's something we're accustomed to, and we just see it day to day. The number of moves. I think we hit that in a market Carver a couple of weeks ago. We're used to maybe going a whole quarter before there might be something that we need to adjust for in the bond portfolio. So we're having to do that continuously. So That's the bond side. Moving out to the equities, and I'll let you cover the two here, which are very technically oriented, the breadth and the risk appetite. And we've seen a little bit of rebound here. So that's in terms of the S&P 500 price. So I'll let you cover to what extent we're seeing it in the other measures too.
Yeah, I feel like I've been sharing a lot of some bearish or bad news in the past couple of market covers. So when we finally had some good news to share, I wanted to bring it. So we're going to start with the good, and then we'll talk about maybe the little less good on the one after this. So what we're looking at here is that the number of new highs on the S&P 500, so large cap stocks, across different time periods. So we have 52 weeks, 1 year, 6 months, 3 months, and then roughly 1 month. And so what we're looking for is we're looking for an expansion in new highs across these look back periods. Obviously, they're going to start at the very bottom. We're going to see 20-day highs before we're going to start seeing 6-month highs. But we want to see expansion here where we're seeing higher highs. More stocks are hitting new 3-month, 6-month, 52-week highs as the equity market starts to rebound off those prior lows. Just as we were kind of looking on the flip side previously, as the market was going down, we were examining and looking for, we starting to see expansion in selling, which would be new 52-week lows or 6-month lows. And so we're always trying to evaluate the health of the market from the internals perspective, because again, the stock market really is a market of individual stocks, and how they're each doing is going to have an impact on the broad indices. So right now we are starting to see expansion there. We're starting to see a little bit of growth on the individual stock front, and that's helping bump up the index, and hopefully this can continue into the second quarter. If we look at the next chart, here we're going to look at the risk appetite of investors. So at FEG, we track a lot of different gauges of risk appetite, looking at commodity markets, fixed income markets, currency markets, equity markets, kind of across the board. And what we want to see is there's different relationships that typically will outperform or underperform when risk appetite is high, or when investors are starting to be a little bit more conservative. Typically, we have something called the consumer ratio. That looks at consumer discretionary stocks versus consumer staple stocks. Typically, staple stocks, think of your toilet paper, paper towels, things that you're going to buy regardless of kind of the economic environment, typically do better when we're in more of a risk-off environment. Consumer discretionary stocks, things that maybe you have a little, you maybe will purchase, companies that will earn your dollars when the economy is doing better and you're feeling more confident. Those types of stocks do better in risk-on environments. So traditionally, that top line where it says equal weight staples versus discretionary, when that line is going down, is when discretionary stocks are underperforming staples. Then we want to look at the small cap versus large cap. That's that middle blue line. And typically, smaller cap stocks do well when the market is more risk on and risk appetite strong, and we're not seeing that right now. Finally, that bottom line, high beta stocks, those more volatile stocks that move a lot more than the overall market, they traditionally do well in a risk-on, a higher risk appetite environment. And unfortunately, during the latest rebound we've had in equities, we're seeing all three of those are starting to go lower, meaning that while the broad market's advancing, we're not seeing an increase in risk appetite, which puts up kind of a yellow flag to us that maybe there's not a lot of support behind this latest round of buying. But again, this is more secondary data to us. What's most important is the price action itself, and that's been higher here recently. But below the surface, while we are in the previous chart, we're seeing expansion of higher highs across the board. The risk appetite to get those higher highs is not as bullish as we would like. So hopefully we start seeing that change here in the next couple of weeks, and risk appetite begins to confirm what the individual stock performance is doing. So I would kind of summarize that as a mixed bag. Some good data, some bad data. We'll see which one wins out going forward, but right now the data is pretty mixed. And so we're keeping a little bit more of a neutral bias in the short term. But again, continuing to follow our models and our process for how we get allocated. But a little bit of a mixed bag this week from the data. We'll reevaluate next week and report back to you.
Thank you very much. One more data point as we shift gears here, and we'll talk about an inflationary data point, more specifically the impact of food and energy. It seems like every week we've had one of these points, but one thing to realize, it's an uneven hit. Different countries have different impacts. One of the things that constantly or usually comes up when you have a surge in, let's say, energy prices, you have a disproportionate impact amongst different types of emerging market countries, because some of them are actually producers and some, like India, don't. But actually, when we combine that with the food here, we can get a fuller look And lastly here, Andrew, I'll let you chime in, and because this is something you brought to the table on Monday, but could be one of the reasons why we've seen emerging market stocks underperform, not just the U.S., but their more developed peers around the globe.
Yeah, so inflation's been a hot topic here in the U.S., and it's sometimes it's hard to not get kind of tunnel vision to what our data is. We see $4 gasoline, people are upset how much they're paying at the pump. Meanwhile, over in Europe, like we would love the equivalent of $4 gasoline. They're paying closer to into the $6 equivalency for their energy costs. So it's important to look at, while we are seeing rising prices here, to look at how that's impacting other countries, because it's a different weighting of how they measure CPI. So what this chart's showing is the breakdown of food, energy, housing, healthcare, education, and other, and how much of their consumer base, what their consumer price index weights those different categories. And there's a much larger weighting towards food and energy in a lot of Asian economies. You can see here Hong Kong, India, where it's almost 50% of their economic basket, so to speak. And so as we're seeing the rise in energy costs and the rise of food costs here in the US, it's even being a larger impact internationally. And that's what we're really focused on. There's some countries, we talked in the past about how Egypt, I believe we made the point, Egypt, their diet's about 40% wheat, and they import a large amount of that. And so when wheat prices go up, that has a significant impact on Egypt, just using them as one example. But across the board, there's much more severe impact on the rising cost of food and energy beyond just the US and beyond just Europe, that can have detrimental impacts to their economy. And we've seen in the past, when we've seen rising food and energy costs, you remember Arab Spring and kind of the political uprising there, and that's what can be a result of the rising cost of inflation, when it has detrimental impacts, especially to some of those emerging economies where they don't have maybe the savings buffer that more developed countries have to absorb those costs. So definitely something we want to keep in mind as we do continue to discuss, continue to monitor the rising commodity prices.
Absolutely. And then thank you, sir. And thank you all for listening. Don't forget to come in and see us. You can scan the QR code on the following slide or give us a call, 800-928-4001. And don't forget that we have a weekly radio show that you can listen to live or however you get your podcast. Thanks again and have a great weekend.